I'm going to be sharing my screen in a second. All right, I hope you can see it. Right now, I need you to confirm that you can hear me. Please type yes or type Y or something in the question section below so that I can see that basically you can hear me. All right, guys, once again, please type yes in the question section in order uh, for me to understand that you can basically hear me. I need your confirmation. I can see that we have a lot of attendees, and I need you to. Hello, everybody. I guess you can hear me right now. If you can hear me, please type yes in the question section. Okay, I need a confirmation from many participants. All right, I received it. All right, okay. Yeah, I guess everybody can hear me right now because I received a dozen confirmation already. So basically, let's start, guys. Let's start the webinar. Hello, everybody. I'd like to welcome you on our fourth webinar, which is called How to Spot Market Reversals. Yeah, and basically how to use them for your benefit. Before we start, let me just quickly tell you that the webinar is sponsored by HYCM, and just some brief facts about the company. HYCM is one of the most recognized names in the Forex industry, boasting a 40 years experience and operational history, and is regulated by two of the world's leading financial jurisdictions, which are FCA and HYCM, with a long track record of providing its global customer base with an outstanding and trustworthy trading experience. HYCM offers clients everything that they need to make informed trading decisions. HYCM has accumulated a large collection of awards since its inception, including World Financial Best Mobile Trading Platform 2017 and Global Banking and Financial Review Best Forex Broker UAE 2017. Its recognition as an industry leader has helped it evolve as an online broker of choice for traders across globe. HYCM offers clients excellent trading conditions, great liquidity, and low spreads, delivering a super efficient service. With its strongest focus on fast execution and low-cost trading, it's always a leader in embracing cutting-edge technology. HYCM strives to stay ahead of industry trends by adopting the latest technologies to cater for its clients' evolving needs. All right, so far so good. I just need to read a small disclaimer for you. That's a must-do thing. I know it's a little bit boring, but we have to do it. So the disclaimer is the following. Any opinions made be personal to the author and may not reflect the opinions of HYCM. All expressions of opinions are subject to change without notice. This material is considered a marketing communication that does not contain and should not be considered as consulting, investment advice, or investment recommendations, or an offer or solicitation for any transactions in financial instruments. HYCM makes no representation and assumes no liability as to accuracy or completeness of the information provided, nor any loss arising from any investment based on a recommendation, focused or other information supplied by an employee of HYCM, a third party, or otherwise. All right, guys, so far so good. I'd like to start our webinar. Today we're going to speak about market reversals and how to spot them. But before we basically jump to market reversals, I'd like to tell you some facts about support and resistance levels, because those levels would be needed in order to understand where there is a market reversal and how can we benefit from seeing this market reversal. So basically, briefly, let's start discussing the support and resistance levels. The concepts of support and resistance are undoubtedly two of the most highly discussed attributes of technical analysis. Part of analyzing chart patterns, these terms are used by traders to refer to price levels on charts that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. So support is a price level. Let me just quickly draw a support zone. Let's take a look at any chart you want. If you want me to analyze any particular chart, you can basically write it in the question section. But we have a Euro USD, and I believe Euro USD is good enough for anybody who's trading on Forex. So basically, a support level, right? We can draw it if in here I see at least this one, which had a confirmation 2 times, yeah, in here once, 2, actually 3 times, and I can basically draw another support level, this one, in here, which obviously 1, 2, 3 got 3 confirmations, then it was broken, and in here it became a resistance. But about this peculiarity of support levels, we'll discuss it a bit later. So right now, let me briefly tell you what support levels are. So support is a price level where a downtrend can be expected to pause due to a concentration of demand, like in here. As the price of currency pair drops, demand increases. Those forming a support line. Resistance zones arise due to sell-off when prices increase. So resistance zones in here, I can basically put a resistance in here, but it's more or less wouldn't be fair. Like in here, see, in here, let me just change the color of this one. Okay. For you to trend line properties, let's make it dark blue in here. Okay, this is a resistance zone. So they arise due to sell-off from when the price increases. Once an area or zone of support or resistance has been identified, it basically provides a valuable potential trade entry or exit point. This is because as a price reaches a point of support and resistance, it will do one or two things. Bounce back away from the support or resistance levels, or violate the price levels and continue in its direction until it hits the next support and resistance levels. So basically, in here, we saw that it broke below and continued until another support level. I guess that the support level can be built in here like this. Yeah. And in here you see that it was confirmed by this small candle in here. Let me just change the color of this one to red. Okay. Most forms or trades are based on the belief that support and resistance zones will not be broken. Whether prices is halted by the support or resistance level or breaks through, traders can bet on the direction and can quickly determine if they are correct. If price moves in the wrong direction, the position can be closed at a small loss. If price moves in the right direction, however, the move may be substantial. Like in here, you see, that the price basically rebounds from this level once, then it rebounds the second time in here, but when it broke, retested it on this. Let me just make it bigger. When it broke, then retested it from here. We see this nice move after this breaking this support level. Okay. All right. So the example shows that a constant level prevents the currency pair price from moving higher or lower. This static barrier, like in here, yeah, you can basically see that those resistance level in here and support level in here, they kind of form like geometrical formation, and the price stayed in this geometrical formation for a substantial period of time. But when it broke the border of this formation, the move was quite substantial. All right, so it's those support and resistance zones are very popular among traders when they analyze the charts, but the price of financial assets generally trends upwards and downwards. So it's not uncommon to see these levels barriers change over time. This is why understanding the concepts of trending and trend lines is important when learning about support and resistance. When the market is trending to the upside, resistance levels are formed as the price action shows and starts to pull back towards the trend line. So in here, basically, this support level was a trend line in here as well. So basically, we saw that the price was moving upwards, and it faced resistance levels in several times. And when it touched it, it jumped on the direction of the trend. So it was a trend line. Okay. The resulting price action undergoes a slight drop off in currency pair price, creating a short-term top. Many traders will pay close attention to the price of the currency pair as it falls towards the broader support of the trend line, because historically that has been an area that has prevented the price of an asset from moving substantially lower. For example, as you can see from the chart, a trend line can provide support for an asset even for several months, right? This is a chart from November, right? Every time the during this bullish movement, every time the price touched the trend line, it was pushed upwards every time until it broke. Okay. On the other hand, when the market is trending to the downwards, traders will watch for a series of declining peaks and will attempt to connect those peaks together with a trend line. When a price approaches the trend line, most traders will watch for the asset to encounter selling pressure and may consider entering a short position, because this is an area that has pushed the price downwards in the past. So basically, I need any currency pair that moved downwards. This would be perfect, right? If we build a resistance level in here, but it's actually quite scary resistance level. Now, let me just, the angle of this level is really, really straight in here, right? We connect those two tops, not this top and this top in here. We see this line. And then when it broke, it used it as a resistance, but then trend continued, and we can build another trend line in here. We can actually put it from, no, basically it starts from here. Oops. Yeah. Yeah. The support and resistance of identified level, whether discovered with a trend line or through any other method, is deemed to be stronger the more times that the price has historically been unable to move beyond it. Many technical traders will use their identified support and resistance levels to choose strategic entry-exit points because these areas often represent the prices that are the most influential to the asset's direction. Most traders are confident at these levels in their underlying value of the asset. So the volume generally increases more than usual, making it much more difficult for traders to continue driving the price higher or lower. All right. One other type of support and resistance levels is round numbers, like round numbers figures. Let me just return this to the previous chart. As we can see here, the round number would be 120. Yeah, let's scroll it back a bit. 120 in here. For British pound, let me find it. A round number would be 140. Yeah, just let me input 140 in here. 135 in here. Okay, approximately like that. So those levels, those round numbers, they can be in other support resistance levels. Let's say it this way. Another common characteristic of support and resistance is that currency pair price may have a difficult time moving beyond the round level, such as 120 on euro dollar, let's say. Most inexperienced traders tend to buy or sell assets when the price is at a whole number because that they are more likely to feel that currency pair is fairly valued at such levels. Most target price stop orders set by either retail investors or large investment banks are placed at round numbers levels rather than at prices such as 120.15 or 120.25 or something like that. Because so many orders are placed at the same level, these round numbers tend to act as strong price barriers. If all the clients of an investment bank put and sell orders at a suggested target of, let's say, 121, it would take an extreme number of purchases to absorb these sales, and therefore a level of resistance would be created. All right. Maybe this is not the best example which I could show you regarding the round numbers, because basically what we can see from the previous price action in here is that the currency basically on the daily chart, I can pull back on the hourly chart, we can see that the currency price touched this level, broke a little bit below it, rebounded, touched it, rebounded, touched it, rebounded, touched it, and at least it stayed on this level. We see that the downtrend on Euro USD last 2 weeks, it was tremendous, and that is basically why this level didn't act like a really nice support, where we can see that it not only stopped but rebounded from this level. In here we can see that it simply stopped and stayed like maybe 24 hours or something like that on this level. All right. If we take a look at the history, we can see that this level actually acted like a resistance level in here, but it was not more like 120, but more like 121 in here. Yeah, 121. So it touched this level, rebounded, touched, rebounded, and so on. And in here, but basically what we should keep in mind is that this level, the round level, in this particular case, 120, with the British pound, it's 140, 135 right now. Those levels can act as a substantial resistance levels or support levels in here. Okay. As many of you could have noticed, in here on both currency pairs, I have a moving averages, and the prices, as well as on the British pound or Euro USD, the prices are quite close to the moving averages. This is a 200 simple moving average. So the moving averages can also be acting as support or resistance levels. So most technical traders incorporate the power of various technical indicators such as moving averages to aid in pending future short-term movements. But these traders never fully realize the ability these tools have for identifying levels of support and resistance. As you can see from the chart, a moving average is a constantly changing line that smooths out past price data, while also allowing the trader to identify support and resistance. Notice how the price of the asset finds support at the moving average when the trend is up, and how it acts as resistance levels when the trend is down. Like in here on the Euro USD on the daily time frame, we basically see two moving averages. The 200, as I told you already, 200 simple moving average, and 50 moving average, also simple one. When the trend was bullish, it acted like a nice support zone, like in here, in this area, and then it broke it. It acted like resistance level. Then it broke it above. It acted as support level, and the support again, and the support again, and it went up, right? So it's the moving average is a dynamic support resistance level. Like in here, basically, if we put, if we see in here, like the trend was falling, and the price basically touched, it almost touched, but the difference is like 5 pips. It doesn't really matter. In here, it touched the moving average and then rebounded. Okay, you can see that this level acted, at least for 2 days, it acted like a strong support level, though it's a dynamic moving average. For the British pound, let me just show you in here as well. Yeah, it was acting like it's not, it's a little bit, there is a gap in here. So probably 200 moving average is not the best parameter that we can use for the British pound. More likely it would be 180. Yeah, looks better, but not completely there. 170, I think. Yeah, in here, you see that it also acted, this 200 moving average acted as a dynamic support zone for the British pound, like in here, in here, in here, and then finally, you see, it also almost touched it and rebounded, and when it broke, it went down, like in here and in here as well. Now we can basically take a look at in other currency pairs, like we have a Canadian dollar. Though it's not a really trendy market, and the moving averages is mixed, so they don't give us proper signals regarding trend. The moving averages are working amazing when there is a trend on the market, like with like in here and with Euro USD, but not when there is no trend. We can basically take a look. It's also not really nice, like in here. All right. So traders can use moving averages in a variety of ways, such as to anticipate moves to the upside when the price lines cross above a key moving averages, or to exit trades when the price drops below a moving average. Regardless of how the moving average is used, they very often create automatic support and resistance levels. Most traders will experiment with different time periods, like we did right now on the moving averages, so they can find that one works best on the specific currency pair. Like I showed you that 200 works amazing, 250 works amazing in Euro USD, and on British Pound it's better to use 170, or probably even smaller, like 160. It may work better. So in technical analysis, many traders have been developed. Many indicators has been used by traders to identify barriers to future price action. These indicators seem complicated at first, and it often takes practice and experience to use them effectively. Regardless of an indicator's complexity, however, the interpretation of the identified barrier should be com, con, consistent to those achieved through smaller methods. For example, one of the indicators which I use sometimes is a Fibonacci retracement tool. It's one of my favorites because it clearly identifies levels of the potential support and resistance zone. I will show it to you a bit later. I do receive some questions right now, like does trend lines only work better on major currencies? No. Trend lines and those support resistance levels, and they work pretty much on any currency pairs. But you have to adjust those trend lines with the exact parameters to use any particular currency pairs. I cannot give you like use only 200 and it works best for any asset you may trade, like stock or gold or oil or currency. No, you have to adjust the specific parameters. But guys, I would to ask questions later when we finish the webinar and the time for questions come, so that you won't interrupt me and we finish on time. Okay, so often a support level will eventually become a resistance level when a price attempts to move back up, and conversely, a resistance level will become a support level. As price temporarily falls back, price charts allow traders and investors to visually identify areas of support and resistance and give clues regarding the significance of these price levels. Like in here, yeah, we saw that the support level became a resistance level after it was broken, like in here and in here. Yeah. If I scroll a bit back, I would also show you that it became this support level, this one, it became a resistance in here when it was broken. This candle basically faced a resistance in here and trend continued. Okay. And on other currency pairs, it works the same. Most of the time, a good support level becomes a resistance after it's broken. Um, so, so basically, price charts allow traders. Let's make it simpler. What are the factors which kind of suggests that the support or resistance level is substantial and it's good to take a look? One of the parameter is number of touches. So the more times price tests a support or resistance area, the more significant the level becomes. When prices keep bouncing off a support or resistance level, more buyers and sellers notice and will base trading decisions on these levels. Like in here, right? It was tested like 3 times, so it's more substantial level than the one which was tested like 2 times. And if we scroll back a bit, I believe like we can find even better resistance levels based on, let me just quickly build. You see, it's not actually very correct. If I build it from here, you see it was broken in here, but if I build it from here, yeah, it was almost touched in here, in here, in here. So it's quite a substantial support level. Yeah. Once again, it was broken and almost it was retested. There is a slight gap of like 15 pips, but we can assume that it was retested in this. So it became a resistance level. And for now, it's a resistance level for now. So probably we would see tomorrow that the currency rebounds from here. It tests this level from here and then continues its bearish trend. So the next factor is preceding price move. So support and resistance zones are likely to be more significant when they are preceded by steep advances and declines. For example, a fast steep advance or uptrend will be met with more competition and enthusiasm and may be halted by a more significant resistance levels than a slow, steady advance. A slow advance may not attract as much attention. This is a good example of how market psychology drives technical indicators. Also another factor is the volume at a certain price level. We basically can take a look at volumes with the help of the volume indicator. Yeah, like let's take a small volume indicator in here. Yep. Like when you see that it touches the resistance levels in here and at the same time volume increases, that's a good sign that probably the market would reverse. So the more buying and selling that has occurred at a particular price level, the stronger the support or resistance level is likely to be. This is because traders and investors remember these price levels and are apt to use them again. When strong activity occurs under high volume and the price drops, a lot of selling will likely occur when price returns to the level, since people are far more comfortable closing out a trade at a break-even point rather than at a loss. And also at time. Support and resistance zones become more significant if the levels have been tested regularly over an extended period of time. So as I've already told you that if the level was good enough to stay for, let's say it's December 2017 until it was broken in February. So it was basically here for 3 months from December 10th or December 11th until February 20th. So basically, yeah, 3 months, it's a good level. So it stayed on this position for 3 months. So the longer it stays, the more reliable it is. So support and resistance levels are one of the key concepts used by technical analysis and form the basis of a wide variety of technical analysis tools. The basics of support and resistance consist of a support level, which can be thought of as a floor on the trading prices, and the resistance levels, which can be thought of as ceiling. Prices fall and test the support level, which will either hold the price, will bounce back up, or the support level will be violated and the price will drop through the support and likely continue lower to the next support level. Determining future levels of support can drastically improve the returns of a short-term investing strategy because it gives traders an accurate picture of what price levels should pop up the price of a given currency pairs in the event of a correction. Conversely, foreseeing a level of resistance can be advantageous because this is a price level that could potentially harm a long position, um, signalizing as it does the area where investors have a high willingness to sell the security or a currency pair or any other commodity. As mentioned above, these are several different methods to choose when looking to identify support resistance levels, but regardless of the method, the interpretation remains the same. It prevents the price from underlying from moving in a certain direction. Okay, so far so good. We've dealt with the support resistance levels, and right now it's time for me to tell you how to spot market reversals. So I do use my own, let's say, strategy. It was developed not by me, but uh, by a friend of mine in cooperation with me. It's called the True Fibonacci Waves Market Reversal. Why it's called the True Fibonacci? Because the way we're going to build the Fibonacci waves, I'm going to remove this support and resistance levels in the meantime. The way we're going to build Fibonacci waves, it's a little bit different from the classical one. The classical one suggests that you build the Fibonacci from high to low. So basically, in any particular moment, when you see the market and you see that, okay, that's a low and that's a high. So what we're going to be doing, we're going to be building a Fibonacci from high to low. Like, oh, sorry, it's not the right instrument. We're going to be building it, yeah, from here to here. And that's it. So basically, that's a Fibonacci that was built in here. And the classical theory suggests that you have to do that. But a friend of mine, Yakub Brahimov, he invented his own theory of how to build the Fibonacci waves. And the funny thing is that it's built on Fibonacci numbers. Let me just quickly show you the Fibonacci numbers in here. Okay, so those are Fibonacci numbers. At least first numbers. We won't need more than 21. In here it's 1, 1, 2, 3, 5, 8, 13, 21. Yeah. And so the main idea is that we build the Fibonacci on a weekly time frame. But how do we do it? We calculate the candles and the amount of candles. If you want to build a Fibonacci retracement level, is that the amount of candles should match a Fibonacci Fibo numbers. Like in here we see 1, 1, 3, 5, 8. So in order to build a Fibonacci, there should be either 3 or 5 or 8 candles for us on a weekly time frame in order to build a Fibonacci. In here, I see that, let's calculate. This is a really nice move in here, but we calculate the one color candles, like in here. 1, okay, 1, 2, 3, 4, 5, 6, 7. It's not a Fibonacci number. So we basically cannot build the Fibonacci wave in here. Instead, the previous move was in here. 1, 2, 3. It's a 3 Fibo white candles. So basically, what can we do? We can build a Fibonacci in here. All right? Okay. So that's a Fibonacci wave. Basically, I have it more extended. The classical one doesn't have 12. It doesn't have 88. So basically, you can add it by yourself. 12, 88. I believe it doesn't have 138.2. This one. I do not remember if it has 161.8 and 250 level. Okay. So basically, in this situation, What can we see? This is the way we build the Fibonacci wave. If you missed something, I can basically repeat. If you missed something, just type in the question section, and I repeat how to build this. So, but let me repeat it really quick. So we take a look at weekly chart, and we find any particular like trendy move, like it's either bearish like in here or a bullish like in here, and we calculate the number of candles of one color candles. The number of candles should match a Fibonacci number, like it's either 3, 5, 8, then we have 13, 21, and so on. Okay. If it matches, we can build a Fibonacci. If we have a really nice movement, but it's not a Fibonacci number, like in here we have 7 candles, it's not a proper way to build Fibonacci waves. In here as well, yeah, it's one white, one black, one white, one black, and dodges all over. So it's not really nice to build a Fibonacci wave. Yeah, okay. So after we build a Fibonacci wave, we can start analyzing chart on daily or hourly time frame. Personally, I do trade on a on hourly time frame, but before I deal with the hourly time frame, I do analyze chart on daily time frame, and I have this Fibonacci, which I have on. From the weekly time frame. They are simply bouncing from time frame to time frame, but they stay on the same position with the same levels. And so basically what we need to know is that there are retracement levels of the Fibonacci's, which can reverse the current trend in a particular moment. So basically, let's see how it worked for this Euro USD pair. Yeah, we drew a Fibonacci. It stayed in the Fibonacci zone. Then it broke above it, 100 level. It stayed on 138.2 level. It faced a support and then bounced back to 100 level. Stayed on 100 level and then went all the way up to 250 level. You see, it's amazing how precise this is. Maybe there was one pip gap or 5 pips gap, but come on, we are analyzing the price moves of like 1,000 pips. Yeah, so 1 or 5 pips, it doesn't simply matter. And you see that this acted as a support zone when it was broken, and then the next resistance zone was 250. It went to 250, it tested it, it almost went to 161 level, tested it one again, retested this one, yeah, and then when it broke it, I can actually continue it a bit below, yeah. Right now, it almost touched 100 level in here. So 100 level is basically would be on the level of, let me not lie, it's 119.45. So right now, it's a really, really, really strong support for Euro USD. So my personal opinion is that I doubt that either today or tomorrow or on Friday this level would be broken, because it's really strong one. And I do think that the currency would basically move a bit up and retest this moving average, this 200 moving average, somewhere in the level of 100. Let me just see, 2080 or 2070, something like that. Yeah. So basically, this true Fibonacci wave theory gives you an impression of how a market can move, and it gives you a fixed, not dynamic, but fixed resistance and support levels. Simply bouncing back from a support and resistance levels is not enough. We have to use an indicator as a confirmation. So which indicator can we use? We can use MACD, we can use RSI, we can use stochastic, the indicators with oversold and overbought zones, and we need to let me just build it for you. Delete this one, and let's go for RSI. Okay. So basically, if you remember from the second webinar, we've built this oversold and overbought zones on 70 level and 30 level. Okay. And what we basically see is that the market, when it faced this resistance in here, it was an overbought zone. So it's a really high chance of trend reversing. And what it did, it reversed. In here, it faced the support of 250 level, and it was an oversold zone, overbought zone, sorry. It reversed. In here, it wasn't, but reversed, but okay. It doesn't work 100% all the time. Okay, yeah? But you see, in here, what I told you, it's a 100 level. Let me build it this way. Okay, on 45 it goes. Yeah, in here, what we see, the indicator is an oversold zone. So it's really high chance of the trend reversing from here, at least to, no, at least to 110. It's minimum, but it's not worth it. I would basically put my order in here on 138.2 level. At the same time, it's a level of the moving average, and it's a really nice level to catch the pair, let's say, to here. And if the trend continues, okay, if trend continues, I would basically advise to sell from here to here. But as of now, I would expect the currency to move from here to here and from here to downwards. But let's see how it goes. At least this, what I wanted to show you is how this Fibonacci wave is working, and how you basically should deal with it. Let me just show you a brief example with Great British Pound dollar. Just delete this one. I'm going to delete those levels. And let's go to the weekly time frame. Let's take a look at what we see here. So this is a nice move, but this is 1, 2, 3, 4, 5, 6. It's not a Fibonacci number, so we basically cannot build it. So 1, 2, it's not a Fibonacci number as well. 1, 2, 3, 4, not a Fibonacci number as well. So basically, now what I would do is I would put my Fibonacci on these 3 candles. It's a Fibonacci number, it's a bullish trend, so we can build it. Sorry, missed it. So we build it in here, yeah. From the top to the bottom, we go on a daily time frame, and what we basically see is that yeah, it's not from the low to high. It's different a little bit on a weekly time frame. But in here, we see that the market faced a resistance on in here. It went back to 50 level. It's a 50 level is a really good retracement level for a currency pair in here. Yeah, stayed it for some time and then continued its bullish power. Unfortunately, it didn't touch this level. Let me see what was the difference. So the high of this candle is basically 43.75, and this candle is 86, maybe 90. So it was 15 pips. It's not a lot, but still, it didn't touch it. right? But it's 15 pips different. But we could, assume that it touched it. I don't know whether it's good to do or not good to do, but let's take a look at the indicators as well. Build overbought and oversold zones. I do sometimes, kind of, I see that this is a good level as well from the previous support zone. And after these levels, I look for opportunities to sell. And when it kind of comes to this level and I see that it starts to rebound and not completely, going to this level, I take a look at the indicator and I assume that I can sell. It does require a longer stop loss. So in the case of a classical, if we wait for this level, for the classical level on 143.90, yeah, I would put maybe 30 pips stop loss. If I go from 70 level, it require me a 50 pips stop loss or maybe 60 pips stop loss, which is substantially bigger. But anyway, I'm targeting at least 100 level. Yeah, at least 100 level that I want to target, and this level goes on the 142 20 20 something. Yeah, it's anyway 150 pips. So yeah, my stop loss could have been 30 pips. In this way, it would be 60 pips. But anyway, my take profit is 150 pips. So, which is still good enough for me. So on this level, yeah, if we assume that it touched it, it's an oversold for RSI as well. So basically, we could have sold it in here. Like, yeah, that's basically how it works. I can take a look at another currency pair. A question appeared. All right, let me just briefly take it. Sorry, which target for your USD for short positions? For me, if it touched a 138.2, yeah, the minimum which I would target, the minimum is 100 level. And at this point, in this particular situation, 100 level in here, it goes on 142.20, something like that in here, 142.20. That's the minimum. I'm not saying that I'm going to take it and that's it. No, I'm going to continue looking for short opportunities, but the minimum would be this one. If it touches 138.2, the minimum is 100 level. Okay. All right. Let me just delete this one and show you another currency pair. And we can try to analyze this one. All right. Okay. Now go to a weekly chart in here. So basically, I'm just calculating. I'm taking a look at it right now. It's 1, 2, 3, 4. Then it's 1, 2, 3, 4. Then it's 1, 2, 3, 4, 5, 6. Basically, I can't find any proper position to build Fibonacci on this currency pair, at least in here. Yeah, I can build it in here and try to analyze what happened in August 2017, but come on, it's not really relevant. Let's move to this 1, 1, 2, 3, 4, 5, 6, 7. 7 is not good enough for us. Okay. Yeah, in here as well. See, cannot find a proper place to put. Let's go for a Canadian dollar. Okay, in here, 1, 2, 3. Yeah, we can build a bullish Fibonacci wave, and bearish one. A bearish one is not really nice. Let's try with a bullish one. Wrong instrument. Okay, but no, all right. Let me just jump to a daily time frame. So basically what we saw here is that the market touched 100, it went to 60 level, then it rebounded to 110, and then, you know, it continued. At the same time, when it was rebounding from 100 level, yep, there was an oversold zone for RSI. So basically we could jump into the trend reversal. I received another question. Can anyone is asking to analyze euro Canadian dollar? Yeah, let's analyze euro Canadian dollar, no problem. But in this way, yeah, you see that it also can be this position, this particular moment in here can be used for your benefit as a trend reversal pattern. Okay, euro Canadian dollar. Let me just find it. Okay, let's go for a weekly time frame. All right, now let's see and calculate 1, 2, 3, 4. Unfortunately, there are no 5 candles. This is 1, 1, 1, 4 in here. That's unfortunate because if there were 3 candles, we could have built the Fibonacci, but unfortunately, here is 4 candles. No way to build the Fibonacci in here, the true Fibonacci wave. In here it was 1, 2, 3, 4, 1, 2, 3, 4, 1, 1, 1, 2, 2, 1, 2, 3. So basically, the only good enough moment until here is these 3 candles to build the Fibonacci. Let's try to build it. Why not? Okay. Yeah, that's the level. That's the level. Let me just go on the daily time frame. Jump and let's see what was happening. Oversold, overbought zones. All right. So basically, we've built it from here to here. Yeah. The market basically went to zero level, almost zero level. It was a 12 level in here, but it didn't give us any confirmations. So it continued its bullish trend until here, until it became oversold. It faced the support as I previously told you with the Great British Pound USD. It faced a resistance in here on 138.2, and the minimum which I would target would be 100 level. So I would have opened a short position. I'm sorry, I don't see these numbers because there is, oh, sorry, because there is a panel, the control panel of the GoToWebinar. So basically what I would do is I would have sold it from here, from the level of 153. It's a round level as well. It's a really good opportunity to sell. This is the RSI is an oversold zone. It faced the true Fibonacci 138.2 level and go minimum to 151.50. Yeah, so which makes 150 pips, and the stop loss would be the best way to put it would be, you know, above this level, but it's more than 100 pips, so I probably would not do that. But the minimum I would do is 70 pips, and it would work fine in here. So it goes. So the profit ratio would be 1 to 2 because it's 70 pips stop loss and 150 pips take profit. So it would work perfectly fine. So selling from here to the minimum of 100 level to here. So what we see next, it's bouncing from here to here. In here, yeah, it goes to 23.6 level, and it almost touches the oversold zone, not completely, and then it rebounds. Unfortunately, I don't see any reversal levels in here. So in here, you see that the basically RSI is an overbought zone. So probably good opportunity to buy. Unfortunately, on this Fibonacci, I do not see any levels. The next level which I would target is 423.6, but it's too far away, so we can't use it in here. Probably if there was some level in here, I would sell it, obviously, but there is no level, so no signal regarding the true Fibonacci reversal patterns. Okay. All right. So if you want to me analyze any other currency pair, so go ahead, just type in the question section. Also, if you have any questions, I'm ready to answer those questions, and I'll be happy to take a look. Just type something. Okay, DAX is more connected to stocks. In here, we just covered the Forex webinars. As you can see, I don't have any indexes in here, and basically, just maybe I can find some. Okay. Let's try to analyze this if I find it. Okay, let me just take a second. I think it's Germany 30. Yeah. Okay, it's called the Germany 30 in here. Let me just jump from this question to another one. Just take a look at the weekly time frame. Come on. Basically, it's not loading properly. I don't know the reason, but it's not loading. Now, for me, I can try to close and open the trading terminal. Maybe it would help. Okay. HYCM. Okay. Unfortunately, I would love to analyze DAX, but the trading terminal for some reason doesn't load it enough figures. So the only thing I can see is this, and basically it's not enough data. So I do have another question. Let me just see it. Okay. So would GBP USD become a good buy due to it being oversold on daily and force? As of now, let me just take a look at it. Is it good to buy it now? Probably not, because obviously, it's a really, really strong bearish trend. And as you all know, trend is your friend. So I would not advise you to buy it when there is a really sharp bullish trend, right? So from my point, it's not a good idea to buy it. Though it's oversold in here, yeah. Let me just rebuild the Fibonacci. I don't remember where it was. Where did we have this Fibonacci? Okay, on 3. Yeah, in here it's also there are no Fibonacci levels, but we need sell Fibonacci levels, and in here we need to find at least 3 bearish candles in order to build the sell Fibonacci levels. Yeah, we have 3 candles in here and in here, and basically if we put it here, Yeah, I guess I can take a look at it. No, it falls to. No, I would not advise you to buy it right now. Yeah, because it's a bearish trend, obviously. That's the strongest reason why I wouldn't advise you to buy it. Okay. Um, I'm not sure that there is a market reversal soon, though the indicator is oversold. It's as of now, it's the only indicator that shows that the market is oversold. But based on one indicator entering the market against the trend, it's not probably a good idea. Okay. We have records of the webinars? Yeah, we do have the records of the webinars, and I guess they're gonna be published soon. But as soon as they publish, you'll be notified by email from HYCM. All right, guys. Do you have any other questions? The time is basically up. So if you have any other questions, I'll be happy to answer it. If not, we're gonna be wrapping up. All right. How to operate with Bollinger Bands? Bollinger Bands was the topic of the first webinar, so it was basically covered in the first webinar. And guys, not really okay with continuing with repeating the first webinar once again. So sorry. Bollinger Bands is a easy to use indicator, and I guess taking a record of the first webinar, you can basically uh, um, deal with it yourself. Okay. All right. I have another question. All right. Okay. No, it's not a question. It's just an email. All right, guys, thank you very much for attending this webinar. I hope it was really helpful for you. In the meantime, after this webinar, we have a quiz for you. Here is a link to the quiz. And I do encourage you to just take a look at this quiz. It's an easy quiz with 5 simple questions, 2 options to answer. After you answer those 5 questions, you receive a certificate from HYCM to your email, which you can keep, you can share in social media, and the certificate would basically tell that you've successfully completed the webinar regarding market reversals. All right, so far so good. Thank you very much for attending. The next webinar will happen on Tuesday, not Wednesday, but Tuesday, May 8th at 4 p.m. GMT. I do encourage you to attend. I'm going to be sharing my insights regarding my 2 of my trading systems, the ones which I use in daily trading, and the ones which are profitable. At least I do use them with slight adjustments for 4 years already, and they work good. And I'm going to be sharing it with you completely free. And so that's why I do encourage you to attend this webinar on May 8th, Tuesday, 4 p.m. GMT. Thanks a lot for visiting, and have a great week. Bye-bye.